Let's go ahead and get started with today's call. I'm really excited about this one. It's going to be heavy on the slides, but I think it's going to be it's a good time to think about real estate and where we're at. And today we're going to mostly focus on the residential side of things. So let's jump in. The question I wanted to ask, I've been asking myself today is I drive around town and there are sold signs all over Nebraska. Now I live in Paradise. It's a little slice of heaven, so I understand this is might not be the same all across the country, but it also might be. So home prices have appreciated in Nebraska here for the past 5 years. We're pushing $300,000. Very affordable state I live in. You can see here how sales have been going. There's been a nice little uptick so far in 2025 after a little dip to start the year. Things are a little bit slower than last year, but it depends where you live, as everything is in real estate: location, location, location. And here's one that I've seen a lot more on Twitter and on Reddit, talking about the number of days that homes are on the market. You can see here in Nebraska, at least, we're starting to trend down a little. We'll see if it ticks back up, but I think this trend line right here at the tail end is significant and will tell us what the future might hold. All right, so let's go into the big picture a little bit more. So, Fred, we got our Fed meetings coming up. It looks like here in June, July, and then September, what are the forecasters saying about potential rate cuts? So here is, there was nothing for June, nothing for July meeting. The forecasts were 0% change. There was like a 99% chance that everything stays the same. Here you can see, though, in September, we've got a 55% chance, or I guess prediction would probably be better, that we're going to see a rate cut in that September meeting. Looking out at the October meeting, we see another potential, or the probability of a rate cut gets even higher. It's over 80%. And then a rate cut forecast in is about 93% by the end of the year. So the market's saying we're probably going to see a rate cut. It looks like the market kind of thinks most likely would be a 25% or 25 basis point rate cut. Later in the year, it kind of gets all over the place, but markets are saying no short term, but in the medium term, probability of a rate cut are high. As you can see, I think the 10-year is kind of all over the place. Here's a year-to-date look at the 10-year. We're around 4.4 with the news from the China thing that just came out this morning. It's dipped about 6 basis points, a little bit lower at the last couple minutes here. But you can see we've can't really get too high above that 4.5 range lately. That seems to be kind of where the 10-year is starting to sit. I like looking at it over time. You can see how the 10 years changed over the past 5 years. Pretty significant increase from where we were back in 2021. No surprise there. And then my dad always shows me this graph and says, "Oh, you think that's high? Well, let's have some perspective historically and see where the 10-year is since 1980. You can see that trend is kind of interesting. It looks like we're peaking up. Are we going to get to that 5%? I don't know. The forecast for the Fed funds rate, at least on the short end of the curve, probably indicates we're probably not going to get above 5. We'll stay there. What's the Fed looking at? Well, this CPI, you can see from this little chart here, it's kind of fascinating that almost all of the CPI, all of the inflation that we're seeing is tied to homes. So rents, real estate, mortgages, that sort of thing. That's kind of interesting. And so almost all the growth is from that housing and rent side. On the other hand, we always talk about with the Fed is population in terms of employment. So we're at a cycle low right now. This puts a burden on people who are working to support the non-working population, which is kind of interesting. You see that the population is we haven't quite recovered since 2020, the COVID response, but we moved up. Now we're kind of tricking low a little bit then. Here's a look at full-time employment as a percent of the labor force. You can see that employment's kind of a leading indicator here of these recessions in gray. Where are we going to go in the future? I don't know necessarily. You can have your own prognostications, but it does tell us something about how the Fed might be thinking. From a credit perspective, we see corporate spreads are tight. Agency mortgage spreads are really, really wide. In fact, they're about the widest we've seen in quite some time. So interesting that this spread widening has occurred. The bond market is kind of stabilized at rates around 4.5, testing where it's going. Kind of interesting to see spreads this wide, at least on the mortgage side. Mortgage rates. I pulled this up for this morning. Nice little tool at Mortgage Daily. You can see the 30 years about 6.93, 15 at 6.2. You can see here, this is kind of how it compares historically where we're at. It's still a little bit elevated. It tries to go down, and then that 30-year rate kind of ticks right back up. We haven't quite been the highs we did at the end of 2023. Kind of stabilized right here just south of 7%. Here's the 1-year chart. You can see that mortgage rates kind of slowly coming down. Maybe not any sharp decreases, but still kind of hovering around that 7% range. I like this one. You can look back a little bit further and see for 5 years, and then obviously going back 30 years, you can see, or sorry, 10 years, you can see here what we're looking at, relatively speaking. Expensive to get a mortgage, relatively speaking, these days. Now, if I pulled the 30-year out, like my dad likes to show, that's a different story. But for the short term, you can see we're really high, and that's going to have a lot to say about the mortgage market, the real estate market, as we'll see here shortly. So let's look at home ownership data. I really like these charts. I think these are really helpful to see. At least, the raw numbers they're meaningless to me. I think some people might like it. I'm more interested in the trends and where we sit. You can see here at the tail end recently, it's kind of flattened out. Sharp increase from lows after in 2014 or so down here. We had a big spike in 2020, and then things have kind of leveled off relative to home ownership rate at the end of 2024 and into this year. This is the money chart in many ways. Home ownership versus 30-year fixed mortgage rate. This home ownership rate is the proportion of households that are owner occupied. So it's not a perfect number, but again, we want to look at trends and kind of see how things are going. Interesting that home ownership has gone up as the 30-year has gone up as well. Not a lot of moving, not a lot of selling. I thought this might be a little bit more different. There'd be much more renters out there, but it's still kind of significant to see that trend, especially at the end of the year where we're at right now. Now let's go into mortgage applications, because this is a good, healthy indicator of the overall market, in my opinion. Are people applying for mortgages? Are they moving? Are they looking for better jobs? Are they willing to sell their homes and go someplace else? Here you can see, again, the numbers aren't as important as what we see is in the trend. So the 30-year mortgage rate has gone up, and the number of mortgage applications has gone down. Not too surprising there, although that kind of this little trend line here from 2022 as mortgage rates went up, nothing too surprising, but man, that's a big spread, relatively speaking, from what we've seen historically. Let's look at the difference between purchases and refinances. I love this chart. I think this is really, really interesting. You can see this big sharp increase around 2003. Interestingly enough, rates went all the way down to 5.1% June 20th, 2003. And then look at that big shot in refinances we saw right there. Kind of crazy, the perspective back then versus now. In contradistinction, way back here in 2020, rates were down to 2.4%. Pretty insane if you think that everybody who could refinance wanted to refinance. And then, of course, at the tail end here, as people kind of went and digested the numbers, you can see not a lot of refinances. And at the same time, you've seen a nice dip in the purchase as well, the number of mortgage application or mortgages actually purchased. Here's how you can see it over time, tracking refinancing versus the 30-year mortgage rate. Nothing surprising there, although that spread is super duper wide. Really interesting play there. People are locked into those mortgages. People are not selling their homes in the volume you'd like to see. A lot of stagnation, people staying from home, working from home, not willing to make moves, not willing to sell their homes to go other places because they're locked into a really nice mortgage rate. And we see that reflected here. I want to kind of jump into home prices and sales as well. So what's the volume of things actually happening? Well, housing is kind of a leading indicator. If you look here, the composite of leading single family residential construction, it's rolling over again. We're still above that December 22 level or 2022 level, but it's starting to roll over again. We're seeing things going down, that lagging indicator before a recession, as you've seen historically with these gray lines. It's kind of interesting to see what that's forecasting. Probably too soon to tell, but it is definitely a leading indicator. Housing is. We'll have to keep that trend really close in mind. Here's new home price averages. You can see over time, the new home prices has gone up pretty significantly. If we kind of drill down that a little bit more, here's the average home price over 500,000 on average across the country. And then if you go to the median, you can see it's just around 400,000. Pretty significant telling. We've seen a nice sharp increase since 2020 in the house of prices, and it's held up pretty well. It's come down since the peaks we saw at the end of 2022, but we still see those prices are still way up into the northeast quadrant right there. That's too high in one man's opinion. New home prices versus sales. You can see this green line is number of sales. Average price has gone up. Price has gone up, and the number of home sales has gone down. Really helpful charts here to kind of see or give some macro perspectives on that. Let's shift gears because new home prices are fine, but where the money is really the existing home prices. That's where the largest volume of inventory really is. Not too different. You can see existing home prices are going way up to that northeast quadrant. Again, we have a chart here that kind of shows how new home prices and existing home prices track, but you can see moving to the northeast. And not too surprising, people are moving to the west, people are moving to the south. Midwest it's a slice of heaven in Nebraska, but not as many people moving here. Inventory is a little slow. Northeast, we've seen an exodus. So a lot of the growth you'll see in home prices is in the west and in the south. In terms of volume, you'll see most of it is in the south. But home prices by region, that's pretty crazy what the west is doing up there. Here's your median home prices. Again, over 400. They're pushing 400,000, a little bit over it now that we're in April and May. Those numbers come forward. So home prices are continuing to move up into the northwest. And then here's your home prices versus sales. Like, kind of interesting. Home prices have gone up, but people aren't selling those homes. Obviously, we would say the reason for that is they know if they sell their home, they're going to have to buy a more expensive home. But you might think, gosh, if the value of my home has gone up like this, I should probably sell it, cash in. But that's not really what's happening. We saw a little start to that here in 2004, but we've kind of leveled off. I think this was people just had to move. Things had to happen. So they were willing to sell and move on. And now we're tracking back down again. Good indicators for the health of the economy. And then here's that chart I had mentioned, looking at the new home prices versus existing home prices, just to kind of see how they fall. Everybody prices the new homes a little bit higher than existing homes. Obviously, dealers have all sorts of incentive package, or new builders have all sorts of incentive packages to help people move, but they're still kind of keeping track or keeping that pace of that spread between new and existing. I think right now you see that spread's a little higher than we've had historically, but maybe not crazily egregious, you might say. And then here's your existing home sales versus the mortgage rate. You see, as rates have gone up, people are holding on to their homes. That lock-in effect that we've talked about quite a bit. People, if you're locked into a 2.4% mortgage like we saw down here in 2022, it's really hard to go into a 7% mortgage. It's just, there's not a lot of move. And here's, we talked about new home sales earlier. Here's that chart that shows where are people moving. They are moving to the south. Not a lot of spread there. The west obviously does pretty well in select markets. The northeast, midwest, not so great, but there are a lot of growth in the southern part of the United States. And then here's the big thing. This is what you need to think about when you see sales. We need to see existing home sales peak and start to perk up. If we know existing home sales are moving, then we can probably consider and think, okay, that's good for the market, at least that trend. We're seeing a trend going down, new versus existing home sales. So people are not willing to go out. And here's another chart that shows sales versus the 30-year. I want to do a little bit of comparison. I thought these were pretty interesting. So I did say, supply demand runs housing like a lot of macro things. Here you can see new construction for sale. So great sign. We've got inventory starting to grow. That is a really good thing. The solution for high prices is high prices. This is the highest level we've seen since 2007. All well and good. However, if you look here, you can see less than 25% of that new construction is completed. That means 75% is either not started or under construction. So that's kind of fascinating. If we go back and we look, okay, we've got great numbers, inventory is growing, highest since 2007, but less than 25% of that inventory is completed construction. That's a really interesting stat. That has a lot to say about supply and demand in the general economy. Here you can see where those starts are coming from. These are new housing starts. They're almost all in the south, a little bit out west, as you probably expect from sales. And then here's how we compare versus years in the past, but would keep in mind 70, these are, for this is existing versus new sales, only 25% of that new inventory is completed. So these numbers are a little bit skewed. You know, we're not at peak, we're not at the levels we've seen in inventory wise from up peak years pre 2020, but we're definitely higher than in years past, which is probably a good sign. Here's your look geographically. Good old Nebraska. We've got more inventory now than we did last year. That's good. That should help prices in general and in the aggregate, especially on the existing front. But it gives buyers options. Better for buyers, not as good for sellers. And here's your big change: the active housing inventory compared to the pre-pandemic levels. Those shifts, man, those are crazy shifts. If you look at Tennessee, Texas, Florida, no state income taxes there, Colorado, and then Arizona, and then look at places like Nebraska, basically flat, Oklahoma, Midwest versus the West. So the South is dominating a little bit there on inventory too. We've shown this before. I think this is a helpful graph. You can see the average total of housing units is in the blue, the light blue. The dark blue is where we're at the end of 2024. There is a big gap in inventory, probably widening a little bit because of, like we said, the starts versus completion. And then to end, I thought this was always helpful too, is, you know, maybe with all this noise and issue, it's been really hard on homeowners and borrowers. But as we'll show here, like there have been low delinquencies. This is the delinquency rate on single family houses, really, really low delinquencies. People are staying in their homes. People are willing to go into default or receivership or be delinquent on everything but everything but their mortgage. So you can see credit card, auto, HELOC, student loans. We're going to see a big pickup in that probably, but their mortgage delinquencies really, really low. People are staying in their houses, paying that mortgage. The asset liability mix has definitely changed for a homeowner's balance sheet, where their house is it their house that's the asset, or is it their mortgage that's the asset? That's a big question. It seems like the mortgage is the biggest asset and the house is probably a liability in many of these cases. That's a lot different than it used to be. And here you can see another thing that shows that kind of highlights these borrowers that, you know, the number with negative equity is record lows, things we haven't seen in a long time. So the state of that homeowner seems to be they will do anything as possible to hold on to their home, not go delinquent, continue to make that regular mortgage payment, which is good. It's bad as these people are locked in. They're not moving. They're not looking for new jobs. They're not willing to move across the country to find a new job. They're stuck kind of where they are. And that has a lot of implications for investing. So big circle back. What's happening in Omaha? Yeah, there are more for sale signs than before, but people are not as interested to move as you think. It all has to do with how much can I sell my house for? Usually moving from high price regions to lower price regions. Omaha, flat. All those other places, moving from California, from Colorado to Texas to Florida. You know, it's all about that spread. How much can I sell my house for? And is that enough to cover a new house where I'm going? If that keeps up, we're probably going to see things that we are. And housing is that leading indicator. So lots to think about, lots to uncover. I think we'll stop there with our 56 slides that we run through today. So thanks everybody for joining us. If you want more information or want to kind of talk through these metrics, how to invest, information on our strategies, just go ahead and fill out a poll here and we'll get back to you right away. So thanks everybody for joining us. It's awesome to be with you. Have a great and wonderful summer. We'll be back again next month with July's Riffin on Real Estate. Take care, everybody. Have a wonderful day.